You're listening to the YPO Tech Network AI Brief, and I'm Stephen Forte. Today's episode is the efficiency paradox. We'll talk about the widening gap between companies where AI is printing money and everyone else. Still waiting for the check to clear. Last week on this show, episode 6, the AI Reckoning, we told you 56% of CEOs were seeing nothing from their AI investments. Zero ROI, and on Tuesday in episode 4, we covered Block's decision to cut 4,000 jobs, nearly half its workforce, in the name of AI efficiency. Today, I want to update both of those stories because the data that's landed since then makes the picture sharper and a lot more uncomfortable. Let's start with the wins because they're real and they're significant. AT&T just published what might be the cleanest AI efficiency case study in corporate America right now. Their chief data officer, Andy Marcus, rebuilt the company's entire AI orchestration layer from scratch. The problem was straightforward. They were running 8 billion tokens a day through large reasoning models, and it was bleeding cash. The fix was a multi-agent architecture. Think of it as an air traffic control system, one large language model acting as a super agent, routing tasks to smaller, purpose-built worker agents instead of throwing the most expensive model at every single request. The results speak for themselves. 90% cost reduction. Throughput tripled from 8 billion to 27 billion tokens a day. Over 100,000 employees now use it daily, with a 90% productivity gain among active users. And AT&T claims a 5x return in free cash flow within the same year they made the investment. Not a 3-year horizon, not a projected return on a slide deck this fiscal year, real dollars. Now Block. We covered the layoffs on Tuesday, so I won't rehash the details, but here's what happened next. Block stock surged more than 20% in after-hours trading. The market didn't just tolerate the cuts. It celebrated them. Block now projects $3.66 in adjusted earnings per share for the full year, beating analyst estimates. Gross profit north of $10 billion, up 17% year over year. Jack Dorsey's quote was blunt: "A much leaner team utilizing the tools we are developing can achieve more and perform better." Wall Street heard that and opened its wallet. The uncomfortable subtext: the market is now actively rewarding AI-driven headcount reduction. That's a signal every YPO member running a board meeting should internalize. And then there's RedBalloon. CEO Andrew Krapichet's tripled engineering output without adding a single hire. 3x productivity, 0 new headcount. But Krapichet's also coined a term worth remembering: the invisible layoff. AI screening tools are quietly locking qualified candidates out of the hiring pipeline before a human ever sees their resume. So the efficiency gains are real, but they cast a long shadow. That brings us to the macro picture, and it's not pretty. The February jobs report landed Friday. The U.S. economy shed 92,000 jobs. Consensus expected a gain of 59,000. That's a miss of over 150,000. Unemployment ticked up to 4.4%. It was the 6th payroll decline since January of last year. Healthcare lost 28,000 jobs, partly driven by the Kaiser strike. The information sector lost 11,000. Manufacturing lost 12,000. Federal government lost 10,000. Only about half of all industries reported any job growth, down from nearly 55% the month before. Challenger Gray reported that January 2026 layoffs hit the highest level since 2009. But the number that should keep YPO members up at night is the wage split. High-income workers saw wages rise 4.2%, middle income 1.2%, low income 0.6%. That is a textbook K-shaped labor market, and AI is accelerating the divergence. The people building these tools are getting richer. The people being replaced by them are falling behind faster. And here's an interesting wrinkle from Vanguard. Jobs most susceptible to AI automation are actually growing faster than they were pre-pandemic. So it's not a simple story of robots replacing humans. It's a reshuffling. The roles are changing shape. The skills required are shifting. And if you're running a company with both populations on your payroll, that tension is about to land in your next town hall. Now, here's where I want to reconcile what looks like completely contradictory data, because this is the centerpiece of today's episode. On one side, you have the PwC 2026 CEO survey. 56% see no ROI from AI. Only 12% have achieved both cost savings and revenue gains. 1 in 5 CEOs say AI has actually increased their costs. CEO confidence in revenue growth is at a 5-year low. Only 30% feel confident. That's the pessimistic read. On the other side, you have a Wharton survey showing 74% of firms that actually measure their generative AI ROI say it's positive. AT&T just posted 5x returns. Block's stock jumped 20%. And PwC's own data, buried deeper in the same report, shows that companies who scaled AI with strong foundations are 2 to 3 times more likely to report meaningful returns. Companies applying AI widely across products, services, and customer experience achieved nearly 4 percentage points of higher profit margin. So what explains the gap? It's not the technology, it's 3 things: measurement, architecture, and execution. First, measurement. The Wharton 74% are companies that bothered to measure ROI in the first place. Most companies haven't. If you can't quantify what AI saved you last quarter, you're not in the 74%, you're in the 56%. Second, architecture. Andy Marcus at AT&T points to MIT research showing that 95% of AI proof of concept projects return $0, 95%. The 56% who see nothing are mostly stuck in pilot mode, running POC after POC without ever moving to production architecture. AT&T didn't get 5x returns from a chatbot demo. They rebuilt their entire orchestration stack. They moved from throwing one expensive model at everything to a purpose-built multi-agent system that routes the right task to the right model at the right cost. Third, execution. The 12% who see both cost and revenue benefits have embedded AI extensively across products, demand generation, and strategic decision-making. They didn't bolt AI onto existing workflows. They redesigned the workflows around it. Gartner warns that 50% of companies that cut staff blaming AI will be rehiring by 2027. Forrester says 55% of employers already regret AI-related layoffs. Carnegie Mellon found that even the most proficient AI workers can only complete about 25% of basic tasks autonomously. So if you cut headcount without redesigning the work itself, you're not getting leaner, you're getting fragile. Here's the takeaway for your next forum meeting. There are 2 versions of AI efficiency playing out right now. Version 1 is AT&T and Block. Rebuild the architecture, move past POC as measure by workflow, redesign how the work actually gets done. AT&T got 5x returns in a single year. Block's stock is up 20%. Version 2 is what most companies are doing, running pilots, trimming headcount for the optics, and hoping the technology papers over the gaps. Half of those companies will be rehiring within 18 months, and the talent they let go won't be sitting around waiting for the call. The question isn't whether AI works. It does. The question is whether your AI architecture works or whether you're burning cash on expensive demos while your competitors build production systems that actually compound. If you're a YPO member sitting on a pile of POCs with no clear path to production, this is your week to fix that. Ask your CTO 3 questions. What percentage of our AI projects have moved from pilot to production? What is the measured dollar impact per workflow? And are we redesigning the work or just automating the old way of doing it? If you don't like the answers, you know where you stand. Measure by workflow, not by vibes. And if your team can't tell you the dollar value of what AI saved last quarter, you're probably in the 56%. That's the YPO Tech Network AI Brief for Wednesday, March 11th, 2026. I'm Stephen Forte. If this hit home, send it to a fellow member who needs to hear it. I'll be back tomorrow with more. Until then, stay sharp.